Hello, everybody. We're going to go ahead and get started. I want to welcome you to this CSG Academy webinar. Today's non-partisan, non-advocative session on telematics and usage-based insurance is presented in collaboration with the Griffith Insurance Education Foundation. My name is Sean Sloan. I'm the Director of Transportation and Infrastructure Policy at the Council of State Governments in Lexington, Kentucky. Let's have the next slide. CSG has been excited to partner with the Griffith Foundation on this webinar and a series of other events over the last year on insurance-related issues. To say more about this collaboration, I want to call on Frank Tomasello, the Program Director at the Griffith Foundation in Malvern, Pennsylvania. Frank.
Thank you, Sean. The Griffith Insurance Education Foundation is pleased to be collaborating with CSG. Both the Griffith Foundation and CSG share similar missions, which include a commitment to a non-partisan and non-advocative academic approach to programming. This commitment's at the core of our collaborative efforts, and our goal today is to provide an opportunity for policymakers to gain valuable and unbiased knowledge about emerging insurance issues through the lens of this critical issue of telematics today.
Great. Thanks, Frank. I'm going to tell everyone about our speakers here in just a moment. Let's go to the next slide. But before we do that, just a quick note on how the webinar will run. Each speaker will talk for about 20 minutes, and we should have about 15 minutes at the end for Q&A. If you have a question for either speaker, you may type it directly into the GoToWebinar interface on your computer screen at any time. There's a questions box on the GoToWebinar taskbar that you can use for precisely that purpose. We will collate those here in Lexington and ask as many as time allows. The focus of today's webinar is vehicle telematics and usage-based insurance. We'll get a detailed explanation of what telematics actually is from our speakers. But at a basic level, it is essentially technology or a series of technologies that allow for the sending, receiving, and storing of information relating to a motor vehicle via telecommunication devices. As we'll hear this afternoon, telematics can allow for the measurement of actual driving habits based on a vehicle's real-time driving data, and that appears likely to have a significant impact on traditional auto insurance models in the years ahead. This afternoon, we'll get two perspectives on telematics. First, we'll hear from Stephen Bayless, who is the Vice President for Technology and Markets at the Intelligent Transportation Society of America in Washington. He's going to give us a sense of how the technology works and its potential implications for policy. Then we'll hear from Dr. Kevin Shaver, Assistant Professor of Economics at Duquesne University in Pittsburgh. He'll talk about how telematics is impacting and will impact insurance models and products, as well as how public policymakers are considering the myriad questions and challenges presented by the deployment of telematics. But first, we turn to Stephen Bayless at IPs America. Let's go to the next slide. Steve is responsible for providing guidance to the organization's board of directors and senior staff on matters involving new technologies, wireless services, and evolving automotive platforms, intelligent transportation infrastructure, operations, and customer services. He previously served as staff advisor and presidential management fellow in the Secretary of Transportation's Policy Office at the U.S. Department of Transportation. Stephen, the floor is yours.
Thank you. I appreciate the opportunity to speak to you about some of the trends in vehicle design and vehicle services, as well as this umbrella term of personal freight mobility. Could you go to the next slide, please? Just by way of introduction, IPs America is a very, very broad-based, kind of big tent industry association. We include, on the industry side, most of the major automakers, most of the major wireless carriers, some traditional IT and emerging tech companies such as Apple, Google, IBM, consumer apps, consumer electronics, and industrial electronics. And then and that's the sort of vehicle driver side. On the infrastructure side, we include a variety of public infrastructure agencies, operators such as road agencies, parking operators, port authorities, airport operators, and others. And then on top of all this, we also have a very, very large research community, very active community within our ranks, with the major research institutions being Virginia Tech, Carnegie Mellon, University of Michigan, Texas A&M, California Berkeley, MIT, and others. So most of our members are focused on just the this new intersection between sort of vehicle infrastructure and driver technology. Next slide, please. So we cover, and again, we cover a lot of issues. A lot of them are related to less about the technology, though I think we're going to address some of the technology issues here, but more about the business and the policy issues around them. Our association is generally bullish about technologies, and we're usually seeking policies and establishing a climate for business that will enable deployment of these technologies in cars with drivers and in our infrastructure. Next slide. So, and we've tried to take a big picture view of things. Vehicle telematics is really just this explosion of data that's coming both into the vehicle and out of the vehicle, and a lot of that data is being either brought to the vehicle by drivers carrying mobile devices in with them or aftermarket devices in with them. A lot of data is collected by road operators and is aggregated by companies like Google and TomTom and provided as traffic and parking weather services to travelers. So there's been, the trend obviously has been enormous amounts of enormous exchanges of data between these elements where, you know, maybe 10, 20 years ago you saw very limited interaction between these parts of the transportation sector. And the one thing that has been clear has been the fact that, you know, we still have enormous numbers of crashes, 5.8 million crashes, about 33,000 fatalities every single year. Congestion is spreading. Where there is data, there's this tendency for it to get stovepiped into systems, though that is changing over time with the development of this data ecosystem. And I think insurance telematics is a part of that, is becoming a part of that data ecosystem. And there's more and more coordination between transportation at the national, local, regional levels, and between road operators, telematics service providers, and public safety officials. So there's this is a trend that we've seen in the last 10 years, you know, amongst our members, especially industry members. And I think the key issue is there's the policy issues, which is the organizational design. How do we design our system now, and how do we need to make changes to address some of these challenges, such as new challenges. When you add connectivity to systems, you have to address the issue of privacy. You're potentially creating vulnerability, so cybersecurity needs to be addressed. Safety assurance and traffic safety regulations also have to be re-examined. And then, of course, there's the issue of the ever-distracted driver as well. So there has to be a focus on individual driver behavior, which is what insurers now are more and more focused on with the development of insurance telematics. And next slide, please. So the real question is, what is telematics? And the term has been around for a long time, and I think if you asked 5 different people what it meant, you'd get 6 different answers. So I'll just give you a provisional answer because I don't think it's ever been really well defined. But it's essentially categorized by different products, different services. Products are generally ones that are either factory installed, they're aftermarket, which means that they're designed specifically for integration into cars, or they're consumer electronics. They're standalone services that get brought in and integrated sort of after the fact. And that last category, consumer electronics category, is the one that has probably been the biggest growth, has the largest growth potential thus far. But on top of those products, you have services, and generally you see three broad levels of service. There's the fleet, the commercial side, which has always been big. There's always been logistics has always driven has always driven telematics on the commercial side. But there's the direct consumer and the indirect consumer, where you might have individual applications providing has a direct relationship with the customer, or an indirect relationship with the customer, such as if you're a vehicle owner and and the service is being provided by the automakers, such as the example of GM and OnStar. So at the services level, the definitions are very fluid and can include a lot, especially on the consumer side, direct consumer side. And usually I feel like it's a combination of features. It's infotainment, navigation, traffic, parking, crash avoidance. I think parking and crash avoidance are now recently probably some of the biggest or most interesting areas. Tolling, commercial credentialing, remote vehicle diagnostics, fleet management, logistics, and then of course insurance. And then of course there's this new category of vehicle ride sharing, and there's so many different flavors of this right now, but they still use a lot of what you would call telematic services or products. So being able to, for example, peer-to-peer car sharing, being able to take a commercial device, consumer device, and turning that into a platform to share your vehicle, having that integrated with vehicle systems so that you provide security and essentially all the asset management functions any rental car company might have could be made available to consumers in this kind of shared economy model. So I think the universe of telematic services is really changing rapidly, and so are the names and the companies, which you see down at the bottom, just a select few. Next slide, please. So one thing that's really dramatic is the change in vehicle design. So over the last probably 50 years, automakers have been focusing primarily on making the cars better at protecting the occupants in the event of a crash. But vehicle systems are improving a great deal with the development of crash avoidance. And there are several different sort of, at the most abstract level, several different types of driver assistance systems. There's the travel advisory systems that tell you, that are basically are designed to improve driver expectations, provide you origin and destination, turn-by-turn directions, guidance to parking spots, so on and so forth. So being able to sort of take some of these taxing activities that take you away from the driving task and trying to sort of integrate them and smooth them into the driving experience. And then you get to a little bit more concrete, tactical level systems which drivers use, such as indirect viewing systems, so rear view cameras, which were recently, which NHTSA recently developed a motor vehicle safety standard for, collision warning systems to direct attention to crash threats. And there's two kind of flavors of these. There's autonomous systems, and when I say autonomous, I don't mean autonomous driving. I mean autonomous sensors such as radars, laser, camera-based systems, and then cooperative, which is this vehicle-to-vehicle short-range communications. and then the collision avoidance systems that they go from warning to actually taking control of the vehicle when the driver fails to do so. And these are the most recent examples include electronic emergency braking, where a sensor will detect that a crash is inevitable and will automatically take control of the vehicle, understanding that the driver will not be able to react in time. So that's one step towards this later thing that you've obviously, this later development, which you've obviously seen, which is driving automation, where the vehicle takes over greater and greater responsibility in not just avoiding crashes, but also automating basic driving tasks, such as maintaining lanes, maintaining headways, and even tactical level navigation. So the other thing that you have to take in consideration, and this definitely affects risks, is the need for driver-optimized interfaces. And this is definitely the problem with people bringing mobile devices into vehicles. The solution thus far has been to have mobile devices brought in and integrating them using Bluetooth into the head unit so that you reduce as much visual manual interactions with the device. There are some researchers that continue to maintain that this is still not an effective countermeasure against driver distraction, and that there are risks of cognitive distraction while people are attempting to multitask, talking on the phone or composing text messages. Even through voice command systems, they're running the risk that they are not focusing on the road. And so workload management, therefore, is a key technology challenge. How do you adjust and deactivate technological components when the driving tasks are high? Maybe talking on the phone is a low-risk activity when you're at highway speeds driving in the middle of an interstate highway in a rural part of the country, but it definitely is a more challenging activity when you're in a larger city in congested conditions. So that's another major challenge that automakers are trying to tackle. But ultimately, the combination of these services will improve safety and really uphold driver reliability, which is the whole purpose of safety management systems. Understanding that total reliability means adding redundancy from different systems that we've discussed: driver assistance systems, optimized interfaces, workload management. Next slide, please. So, and again, the potential for drivers is you have these systems that not only perceive and decide, initiate driving responses, but can, but can understand that driving tasks, or driving demands will often exceed driver capabilities, even the best drivers, and that the understanding that driver error now accounts for 45 to 75% of roadway crashes. That's a conservative estimate. It's probably closer to 9%. So essentially, these new systems attempt to use vehicle sensors to perceive threats and use the driver and algorithms to decide responses. So the drivers is supported, and so that we don't have the situation where the driver is always the weakest link in the safety chain. And so we think that most of our members think that new technologies can reinforce safe driving behaviors in real time, not just incentivize them, but also encourage them by providing feedback whenever there's a near crash or another event that occurs. You can provide feedback whenever a driver is taking curves at too high speed, or doing other activities in the car besides driving. And then there's, besides these new crash avoidance systems, they're both kind of integrated either by the automakers or brought in as aftermarket devices, you have this new potential for cooperative crash avoidance where vehicles can actually coordinate activities. This is, again, a long-range activity, long-range technological development, but is something that we probably will see in the next decade. And then, of course, what everyone is interested in is whether you can have a car that drives itself, the use of artificial intelligence to entirely replace the human driver. And this is something that Google and some other companies are attempting to do and commercialize, and are currently going state by state to try to change the laws and the rules related to vehicle registration and licensing. Next slide, please. So with that being said, again, the changes in vehicle design have really been dramatic, and in reaction, the National Highway Traffic Safety Administration has decided to just lay out some basic guidelines for where they see these new systems and how they're going to categorize them for the purposes of probably in the future attempting to establish some motor vehicle safety standards around them. And I won't go into, some of them we've already discussed, such as automatic emergency braking, which is sort of a function-specific automation where you're trying to avoid one particular crash scenario, such as a rear-end crash. To combine function automation, combined function automation would be a system a little bit like what you've probably seen Tesla do, which is this essentially version of what is called traffic jam assist, where the vehicle will not only avoid potential collisions with other cars, but maintain driving tasks along the roadway across different scenarios. So we'll maintain lane, we'll maintain headway, and where the driver can sort of relinquish controls of the steering and foot pedals. Beyond that is level 3 and level 4, limited self-driving and full self-driving automation, where the driver cedes full control, is never asked to sort of maintain control under certain conditions, and then full self-driving, which is essentially a robotic vehicle where you may not even have to have a passenger in the vehicle at all. It essentially is a drone and can have full range, full spectrum navigation at the tactical level. Next slide, please. So the states have been enacting laws right now looking to change some of their registration and licensing rules related to this. California and Nevada are the principal ones. California recently had draft rules that explicitly ban cars without human drivers, and they also prohibited the commercial use of the technology until further notice, which was deeply disappointing to a lot of companies that are seeking to commercialize these vehicles sooner rather than later, and are convinced that they are probably safer than human drivers. So the question of safety assurance, how do you know whether a system is safe without being able to collect the data, without huge amounts of data to sort of prove whether the system is safer than a conventional car being driven by a human driver, that remains to be seen. And in reaction, I think NHTSA is attempting to sort of create some best practice guidance for the states to support their efforts. Next slide, please. So, obviously the big changes involved in vehicle design, and but the one thing I think we've seen also is infrastructure is changing a great deal. Again, driver and vehicle factors contribute to causation of many more crashes than do road infrastructure factors. Engineering standards for roads have been developed over more than a century, and so most risk is not in the infrastructure side, though. There are efforts by some, such as the U.S. Road Assessment Program, to create historical crash data and safety relevant road inventory data that essentially down the road could establish sort of risk maps of where where it might be more dangerous to drive vehicles, and down the road I think that might have implications for risk management and even insurance in the near future. So, for example, a driver, a route choice might be rely on a combination of factors, optimizing between efficiency, such as time savings, fuel savings, environmental impact, and at the end of it, you could have not just quickest route, most fuel efficient route, but you also might have safest route as well. So, and for the most part, road authorities, I think, are looking at competing transportation projects not just on the impact mobility, but also on their overall contribution to improved safety. And down the road, what we'll see probably in the next 5 years is the growth of this cooperative crash avoidance systems that have an infrastructure component, such as at intersections where you might have a sort of intelligent traffic light that is adaptive, that would, for example, be able to detect oncoming flows of traffic and provide right-of-way, give greens to the larger flows of traffic in an adaptive way to improve mobility, but could also, in a pinch, could also provide some basic crash avoidance features at the intersection. Just by way of example, there's a University of Arizona, Arizona DOT Maricopa County system called Dilemma Zone, which essentially allows the intersection to assess whether a vehicle is in the dilemma zone. The dilemma zone is something we've always experienced. It's when you're driving towards an intersection and you get the yellow light and you have to make a quick decision as to whether you want to blow through that yellow or slam on the brakes. Both of those decisions have potential safety impacts. You may get T-boned in the intersection or you may get reared end. And this is especially true for heavy vehicles that don't have the stopping distance. Really intelligent DSRC-based vehicle infrastructure applications can essentially hold the reds on opposing sides of traffic to let that sort of risky traffic through. So even at the crash avoidance level, you can tweak the way the infrastructure operates in order to improve safety outcomes. Next slide, please. And then finally, there is evidence that was trickling in that crash avoidance features actually drive down insurance claims. And IIHS has done some studies looking at crash avoidance features of sort of early generations of vehicles with automatic emergency braking. They've found that property damage liability claim frequencies, for example, for the Volvo XC60, have been lower than for equivalent vehicle categories, and they found, statistically significant results, 14% fewer claims on property damage, and when compared with the same models without the feature. So there is evidence, and this is only for one type of feature that describes one crash scenario. When you look at vehicle-to-vehicle communications, or you look at automated driving systems, these type of systems would cover a number of different crash scenarios, so you probably get even bigger bang for the safety buck there. Next slide, please. So obviously this new technology is gaining momentum. 20 automakers just recently announced with NHTSA and IHS that they would make automatic emergency braking, the one that you saw in the Volvo XC60, a standard feature on virtually all cars no later than 2022, which is a big deal. I think, right now, long range, let me skip a little bit and talk a little bit about automated driving. Lyft and GM announced Express Drive to help sort of lay the infrastructure for fleets of self-driving cars down the road. The difference between what you see is sort of commercial systems such as automatic emergency braking and these self-driving systems. Likely, for example, the California regulations don't allow individuals to own these vehicles. They have to be leased. And ostensibly they need to be leased because they need to be sort of very carefully managed and operated by a fleet operator. In the case of Google, it would be Google. In the case of Lyft and GM, it might be Lyft. So this merger between automated systems and shared use mobility is probably going to come about to sort of marry the business model with the higher cost of this technology that's in the car. On top of that, you'll see vehicle-to-vehicle cooperative crash avoidance. That's just recently matured. GM announced that it'll see its first deployment in Cadillac in 2017, and other OEMs already have prototype devices and are waiting for the NHTSA go-ahead with their rule. And then with that being said, there's still growth in long-range telematics, and I didn't really describe this too well in the beginning, but the stuff that I've been describing to you about crash avoidance has been, especially vehicle-to-vehicle, is just really localized sort of communications between the different, between vehicles and infrastructure. Long-range telematics is this sort of cloud-based concept of being able to collect massive amounts of data from vehicles, driver behavior data, sending it off board into the cloud and having it crunched and analyzed. This has always been sort of a function of development of a robust ecosystem that can do that, and also just getting the equipment in the car, getting modems, cellular connections in the vehicle, which is growing. I think by 2017, the estimate is about 60 million. And the long range, you'll see cars looking more like your iPhone, where it's just kind of a managed device. Managed remotely for any number of different, for remote diagnostics, for servicing, and then also essentially a platform for other sort of telematics services. And the only other thing I'll just add here, and I'm only doing this because it is a policy issue, and this is a policy webinar, and it's something that's right in front of us. Literally, it's maybe a few days in front of us, is the proposed regulation on V2V. This is sort of a potential legacy for the Obama administration moving forward, which is development of this system, which was actually IPs America petitioned the FCC for spectrum to do vehicle-to-vehicle crash avoidance communications about more than 15 years ago. Over the 2000s, the auto industry, in collaboration with each other, and a consortium had developed some crash avoidance systems, cooperative crash avoidance systems, and now we're at the stage where NHTSA would like to do a federal motor vehicle safety standard. That standard right now is being reviewed by the White House. If you could turn the slide. But it's controversial, and strangely enough, it shouldn't be that controversial. Unfortunately, cable industry wants the spectrum that V2V is dependent upon, and so they've been pushing hard in the White House not to let the rule through. Lots of rules end up coming out of the end of administration, so we're fighting the fight with the cable industry. I'll just go on to the next slide, please. So, and I think the next presenter will talk a little bit more about insurance telematics, and generally what we've seen thus far is the objectives are very clear. It's how you actually execute on these objectives. Lots of data to be made available from vehicles, but the question is how do you reduce claim volumes? How do you reduce claim processing costs, which is a little bit easier problem to solve? How do you overcome all the regulatory hurdles, which obviously many folks on the call are interested in because it is a state-by-state regime? And then how do you overcome other business model constraints, which there are many of. Next slide. So, you know, the real questions are what kind of driver vehicle road data can be collected, what insights can be generated about risk factors, how do these companies identify risky behaviors, how do they provide useful driver feedback above and beyond, you know, what premium they're charged, what risks are analyzed and priced for user-based insurance, what are some of the other business model considerations. And I think this is especially important, transparency, education, and consumer acceptance. You really have to change the way business is done. You have to have a much closer relationship with your customer, and that's something that I think insurance industry is, it'll be challenging for them to change that customer service model. Next slide. And so, you know, some of the key questions, and I think they'll get covered in the next presentation is, and at least I'll just go through one of them, is how will insurance telematics incentivize adoption of new technology in cars? Is it really going to reduce costs and incentivize people to upgrade the vehicles to safer vehicles? It's a big question that folks in my industry association constantly ask. And you know, will regulators be comfortable with how insurance companies evaluate risks? All good questions. And so with that, next slide, please. With that, I'll just leave it for the end to ask questions and just pass it over to the moderator.
Great. Thanks, Stephen. Again, if you have a question for either of our presenters this afternoon, you may type it into the GoToWebinar interface in the questions box at any time, and we will ask as many questions as we have time for at the end of the hour. Let's go to the next slide. We're going to turn now to Dr. Kevin Shaver. He teaches economics at Duquesne University. His professional experience includes 2 years at insurance provider The Hartford, where he analyzed insurance markets and the development and management of insurance products. Dr. Shaver has also been an instructor in economics at Washington University and Webster University, both in St. Louis, and at the University of Kansas in Lawrence. Dr. Shaver, we're pleased to have you with us as well. The floor is yours.
Thanks, Sean. Let me start by just thanking CSG and the Griffith Foundation for giving me the opportunity to speak here today. You know, these are really interesting issues, and there are a lot of complexities here. And I'll do my best to try to highlight, from the perspective of an economist, how to, you know, the scientific perspective on the way insurance markets function with these new technologies and concerns that we might need to be thinking about going forward. I am going to try to, as I go through this, I might mention a few things that sound like suggestions that this is how we should do a certain thing. That's always really in the context of thinking about efficiency. So as economists think technically, not meant to say this is how things should be done from sort of a policy perspective. Certainly there are issues like equity and, you know, that have to be considered that go beyond what an economist can say. So with that, why don't we go to the next slide, and I'll just start by looking at, you know, with this, looking at a brief overview of telematics being used in auto insurance today to get a sense of where things are currently. So there are 4 real models for deploying auto insurance telematics right now in the insurance industry. The first one here, the dongle, is probably the most common. In fact, I think there's no doubt about that at this point. And this is just an insurer-provided device. The insured actually installs this themselves, plugs it into the car, oftentimes for just a very limited period of time, maybe you know, a month, 6 weeks, in order to get a sense of how they drive. Right? So the insurance company collects that information and then determines the premium, how that might change based on the data they've collected. So some examples of this, Progressive Snapshot is a classic example. Progressive's been a leader in telematics and insurance. Just to give you a sense of some of the things they even collect, they look at the speed at which people drive, the time of day that people drive, the amount of miles they cover, They look at the rate at which cars accelerate or decelerate. So they oftentimes measure harsh braking, things like that. So you can get a sense that it's, you know, I think oftentimes when people think about telematics, they initially think of just mileage, when in fact these technologies are allowing insurance companies to capture, depending on the regulations in the market, quite a significant amount of data. So the next broad category are embedded devices, and I think Stephen actually talked about this a little bit. So this is a device that actually is, that comes with the vehicle that the auto manufacturers have actually installed themselves. So OnStar would be an example. So companies like State Farm, using their Drive Safe and Save program, they in fact will partner with OnStar to collect the data that they use for that insurance program. So this is nice in the sense that the material is, all the equipment is already there. The problem then, though, from an insurance company's perspective, is that every different auto manufacturer has different standards, and so how, which consumers can you actually offer this opportunity to can be limited, and certainly older vehicles pose a problem. The next category is smartphone-based. So smartphones happen to be, a very easy way to collect data in the sense that they're, almost ubiquitous now. So it doesn't involve, something that's been installed on a vehicle. It does, on the other hand, have a number of drawbacks. But I guess what I would say here then is that I think this is a growing area as insurance companies are finding more ways to address those drawbacks and get more reliable information through smartphones. You'll note here that one example I've given you is State Farm's Drive Safe and Save. Of course, I mentioned that under embedded just previously, but the reason why that's there as well is that, in fact, a lot of the smartphone, uses of telematics can partner with other embedded technologies, and so, in fact, State Farm actually has a program that utilizes both of these things, and they can be independent of each other as well. And then I might mention the More Than Drive. That program also is nice in the sense that it illustrates how insureds can receive feedback on their driving and what's happening to their rates real time. So I'll talk more about that later, but one of the promising things about the use of telematics in insurance is that it can change the sort of cost-benefit analysis that drivers engage in and potentially make drivers safer drivers going forward. The last category, which I won't really spend much time on, the black box. This is something that is professionally installed into the vehicle, provides a great deal of data. It's not used broadly in the U.S. It's actually used a great deal more in the EU, in Europe. Okay, so next slide, please. Okay, so let me take a few minutes then to talk about the potential benefits and costs of telematics in insurance. And I want to think about this from three perspectives, from the perspective of three groups: consumers, insurers, and then also society. And even though society overlaps those other two, there are certain things that are better seen from the vantage point of the society as a whole here. So let's start with consumers. Some of the big things from a consumer's perspective is that telematics offers the opportunity for insurance companies to price more fairly, in the sense that they can identify better how risky a driver is and set a premium that's commensurate with that level of risk. So what that means then is it reduces the cross-subsidies that exist between high and low risk drivers. Typically insurers identify pools of drivers that they can't really differentiate from each other and charge one premium to those individuals. But with telematics then, being able to separate out the good or the higher and the lower risk drivers even within those groups allows more precision in pricing. And so for safe drivers, they are going to be within those groups, they're going to be rewarded with lower premiums. Now, of course, there's potentially a flip side depending on the nature of the regulation in a state that higher risk drivers will face higher premiums. So the next point then, it becomes easier to measure for drivers, for the consumers of insurance, to measure the expense that they incur when they drive. So you might imagine that individuals will, if they're more aware of how much they pay in insurance when they drive, because they drive to work, might think about relocating when they're moving to a new apartment closer to work, or consider driving, taking public transportation or some other carpool, things like that. That cost-benefit of analysis, as it stands now, you pay insurance once or twice a year. Most drivers do at least, and they don't think about how changing their behavior might alter the expenses that they face. All right? So this potentially allows that to become a much more present thing for drivers and thus potentially alter behavior. Which leads to the next point, that telematics, if there's feedback for the drivers, provides opportunity to incentivize safer driving. That think about progressive and the recognizing how often there is harsh braking. Right? So they, they may be able to get feedback saying, look, if you drive at lower speeds and brake less harshly, less frequently at this harsh level, you'll see a 10% discount in your premiums, right? And so people can learn from that and find a better balance with respect to safety than they have prior to telematics. With respect to insurers, then, there are a number of big benefits, and none of these are exhaustive, of course, lists. But so one is, and I think Steve actually mentioned this to some degree, that there will be a reduction in claims costs that potentially through telematics, through the data that's available. And you can think about a number of ways that might happen. Insurers might have much better, almost like a black box recorder on an airplane. They're going to have, they might have much better data on what actually happens during an auto accident. And so they can estimate better the costs that they're likely to face as a result of that accident occurring. And then there's another element there where that insight into the driver's situation might actually allow them to mark early on the potential for fraud and then be more targeted in investigating insurance fraud. Of course, with all of this, you have to think about how they can actually use this data, and that becomes costly. So that brings us to the top bullet point here, that costs, there will be costs associated with this technology and the use of the data. And those become administrative costs that will likely be passed on to consumers. And so trying to think about how to balance the benefits from this technology versus those costs is critical for policymakers when they're thinking about regulations. And then finally, one thing that's very appealing, I think, to insurers is this idea of the increased accuracy in pricing. And I've already mentioned that a little bit from the consumer's perspective. The one thing I want to mention here is more a competitive issue when I'm thinking about it from the perspective of insurers. A lot of my research is actually focused on this, which is the potential for insurers that gain an advantage in the way they assess the risk and then thus price individuals that they're insuring. That when they have an advantage in doing that, if they're able to do that better than their peers, then they can gain a competitive advantage. And that can lead to a variety of impacts on markets that are oftentimes seen as a market failure. Things like prices being unnecessarily high, individuals being pushed out of markets due to that, some firms making extraordinary profits. So one thing that, there is a profit advantage potentially there, and so that's something that insurers certainly are going to be interested in. Then finally, from the society perspective, a couple quick things here. So improved driving safety, this sort of goes back to what I was mentioning about incentivizing consumers. If we can reduce the number of accidents, both between drivers of vehicles and pedestrian driver accidents, there's a great value in that. There's a lot of cost associated with those accidents. So to any degree that this telematics can actually improve safety, this is a significant benefit. But then there are also some more subtle things like the reduction in congestion on highways and city streets. If the feedback that consumers get about the price of their insurance leads them to drive less, right, because it lowers their expenses, that can have then the effect of reducing the amount of vehicles on the streets, so less problems with having to build new infrastructure to deal with congestion issues, lost time in commutes, etc. And so again, a lot of costs there. And then finally, this goes along with this, the reduction in automobile emissions, right? That less time spent idling or while waiting in traffic, and then driving maybe more defensively, less aggressively. Many of those things will lead to fewer emissions. Okay, so could we have the next slide, please? Great. So as I mentioned earlier, I want to be really clear that this is meant to just sort of convey details of what makes markets efficient from a scientific perspective. So as I talk through this slide, I'm going to really highlight 3 important issues that economists oftentimes focus on when we're thinking about markets working well. Right? But again, that's divorced from the idea of how we on a field things should work in terms of equity or fairness or a lot of the anti-discriminatory sort of statutes that exist. We're sort of just thinking about standard market functioning here. So the 3 big areas I would think about that first come to mind with respect to telematics is the top one, encouraging consumers to buy in, right, to telematics. Despite these concerns about that, certainly the insurance industry has found as they've been developing these technologies, 2 big concerns really are the use of the data itself by insurance companies, and then privacy associated with that, and who owns that information. All right, so all the benefits I was talking about in the last slide, well, those rely on consumers using telematics in insurance to a significant degree. And so the more that it can be, that consumers can be assured that they understand how this data that's being collected on their driving can be used and how it cannot be used, and then the certainties that they have about the privacy of that data, and whether they can own that, whether like whether it could be portable, for instance, and they actually own that data themselves, or whether that data is owned by the insurance company. These things need to be clearly enough resolved so that consumers will be able to feel comfortable purchasing products that utilize telematics. Otherwise, you have a demand problem. The second major issue then is the promotion of the free flow of information. And I mean this with respect to all parties. So when I think about by parties here, I'm referring to insured, so the drivers, insurers themselves, the companies providing that insurance, and regulators. Right? So these 3 bodies of individuals need to be able to have the right information they need to make decisions within the decisions they make within this market in order for it to work well. So a couple of big issues there that jump out. Think about standard markets for other goods and services. It's oftentimes very easy to go out and price shop, to decide, well, look, I'm looking at buying a car. I can go to 3 different dealerships and I can find, I can see how expensive competing models but similar vehicles are, and then compare those prices as a part of my decision making. But when you're starting to think about telematics, if individuals, the consumers themselves, don't own their data, it becomes very hard to compare the rates that they get with the insurance company they're currently with, especially if they're using telematics, to what their rates might be with a competitor's product once that competitor has the data on how they drive themselves. So potentially telematics makes it very difficult to compare the prices, and that reduces the pressure for competitive rates in a market. And so that's certainly an issue that has to be considered. So there's also this need for feedback. Many of the things I mentioned, the potential benefits that I mentioned earlier, were related to feedback that allowed individuals to adjust how in fact they were going to drive their vehicles in order to incur savings. So if that feedback isn't made available, then we lose that component. So there needs to be a focus on that information flowing back to consumers. And then also, I think in particular, I'll highlight the need for resources and maybe an adaptation of departments of insurance to deal with these highly complex new types of products. And that may also involve more money to to support the analysis, both in terms of making sure the products are consistent with statutes, but also in order to make that analysis, to expedite that analysis so insurance companies can adapt their products as quickly as possible and get them out to individuals in the lowest cost way possible. Finally, the last portion, the last thing I want to mention on this is that we don't want to lose sight of the need for innovation and how the nature of regulation of telematics might influence the way telematics in insurance evolve over time. So a couple things to think about for policymakers. One is that given that competition in these markets could actually suffer from a lack of balance in ability to use this technology across competitors and have negative effects on the consumers in those markets as a result. Something that we haven't thought about oftentimes in insurance regulation before, but I think needs to be thought about going forward with this technology, is the balance across competitors. How many firms are actually using telematics, and how many do we need before the market's going to function all right at an efficient level, or as close to an efficient level as possible. We also, it's important, and this is something I'll talk to a little bit here shortly, that you want to incentivize insurers to innovate. A lot of states, by statute, are required to release the insurer's rates, make them public when they start using those rates. And if that's the case, then it's hard for insurers to gain an advantage through spending money on developing innovations, because those innovations aren't protected. And so some sense of, how do we address the desire to protect innovations that are costly is important for us in this market. So maybe in this case, limiting the flow of information. And that raises this other issue about balance again. Well, it may also be a problem if, for efficiency, if various firms have different levels of ability to use the telematics technologies. So maybe a couple firms all the firms have telematics, but some are 2 or 3 years behind. Right? That may still have serious efficiency considerations to consider. The final thing then here on this slide is that when thinking about telematics and insurance, you want to think, in my opinion, very broadly, because it's not necessary. While most of the action right now is in auto insurance, there's no reason to think that these types of technologies won't spill over to homeowners insurance or life insurance. And so when thinking about how to promote innovation, you want to have a framework in place that promotes innovation broadly within insurance and isn't too narrowly focused to a particular product that exists currently. Okay, could you move to the next slide, please? All right, so real quickly, I want to give you a little breakdown of how things look in markets right now. Now, it's changing pretty quickly, but this is I'm going to use data on the next 2 slides that come from a study done by the NAIC, where they did a comprehensive survey of the states and the penetration of telematics into their insurance markets in the middle of 2004. And so this is the broadest sort of data we can find out there right now that I'm aware of. So first off, the use of telematics. Remember I was talking about how balance is important. Well, the survey finds that in May of 2014, 5 markets didn't have any companies using user-based insurance programs or telematics. California did allow user-based insurance programs or telematics, but they had a very limited focus, only allowing firms to measure mileage using this technology. 10 other markets, 10 additional markets had less than 5 companies, so a very small number, one where we would be concerned about, how efficient the competition is between companies because there's so few using telematics. Then 15 markets, you had between 5 and 11 insurers offering user-based insurance programs. 8 markets had 12 plus. And then there were a number of markets, this isn't an exhaustive list, some didn't respond. We don't have information on some markets, but 9 responded, but were unable to give precise information. Right? So there are a lot of markets out there where I think it's clear that the technology is out ahead, and we're all, consumers and regulators are having, and policymakers are having to think about how to catch up. What does this technology mean? Let me give you a little bit in the way of specifics briefly here about policies. Virginia specifies a variety of things in their statutes specific to telematics. They define telematics, and then they set up a lot of standards for how individuals have to be treated who decide to stop using telematics but continue to insure. So renew a policy but don't want to use the telematic aspects of the company's policy going forward. Illinois provides protection of proprietary trade secrets. So again, like I said, that's an important component for promoting innovation, much like a patent is when we're thinking about usual intellectual property. Washington provides some data use qualifications or exemptions on how data can be used, what has to be made available to the public. Delaware has a policy where they actually only allow premium discounts. As I mentioned earlier, I think it's important from the perspective of an economist to be very careful about that. Just because you only allow insurance companies to lower premiums if people use telematics, that doesn't mean that the premiums of those that choose not to use telematics won't go up because of the use of that technology. It just will happen in a less direct way. And so policymakers need to know that you can't just legislate lower prices without having unintended consequences of that sort. And then finally, the last slide, please. Great. So this slide, I just have a number of states, again, 3 states, and really what I want to illustrate here is the difference with respect to their approach to telematics in 2 ways. One, in terms of the willingness to allow, or the rate at which they're willing to allow new products to come into the market and then figure out, and allow, companies to experiment with them in the insurance market. And then also the policy towards promoting innovation. So California in particular, as I mentioned earlier, the policies limit the use of telematic devices to just collecting mileage. So that makes, that reduces the potential value of the telematics, of telematics and insurance to insurance companies. And they've raised a lot of concerns about the validity of telematics data. In Illinois, we have a situation where they're very open to companies using telematics, so they don't have restrictions like California does. And they have, in 2011, they passed statutes that provide very clear guidance to what information insurers can keep secret while they're still writing business in the state. And then finally, in New York, we have another example where they're very willing and open, and in fact, want to see companies bringing telematics products into the state, but they provide no specific guarantee that they get that those algorithms, the telematics approach that the companies are using with telematics won't be made public and thus become available to their competitors. And so this limits the desire of firms to innovate and then bring those innovations into the market. Okay, I think that's all I have then for this.
Great. Well, thank you, Dr. Shaver. And ladies and gentlemen, as it turns out, we've blown past the end of our time for this webinar. We typically like to keep these to right around an hour, but a lot of great information we've heard from our speakers this afternoon. We did not receive any questions from the webinar audience today, but I'm sure these guys would welcome any questions that you may have, and I can certainly put you in touch with them if you do have questions. We want to again thank Stephen Bayless and Dr. Kevin Shaver for their participation. Thanks also to our friend Frank Tomasello from the Griffith Foundation. This webinar will be archived in the CSG Knowledge Center, so if you missed any part of the program or would like to recommend it to a friend, it will be available soon. Be sure to check the CSG website for information about future eAcademy webinars as well. I'm Sean Sloan at CSG headquarters in Lexington. Thank you for joining us.